Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Hedge Funds Explained, how they work and why they matter in 2024. Understanding hedge funds. Hedge funds. You've probably heard the term tossed around on financial news channels or in conversations about investing. But what exactly are they, and why do they matter? Hedge funds are private investment partnerships that pool capital from accredited investors, deploying a range of strategies to earn active returns. They play a significant role in the investment landscape, often seen as both high risk and high reward. In this video, we'll explore what makes hedge funds different from other investment vehicles, their strategies, and their impact on the global market. Whether you're an aspiring investor or just curious about the financial markets, understanding hedge funds can offer valuable insights into the complexities of investing. So, why not dive in and discover what these financial powerhouses are all about? What are hedge funds? Hedge funds can seem like a tricky puzzle, but think of them as exclusive clubs for advanced investing. They are unique compared to mutual funds because they can invest in a wide range of assets, use complex strategies, and often aim for higher returns with higher risks. Unlike mutual funds, which anyone can buy into, hedge funds usually cater to wealthy individuals or institutions and are less regulated. This means they have the freedom to explore a variety of investment strategies. Characteristics of hedge funds. Hedge funds have some distinct characteristics that set them apart. Investment strategies. Hedge funds use many strategies to try and make money. They might bet on stocks going up or down, take big positions in bonds, or even invest in currencies and commodities. Their main goal is to beat traditional market returns. Liquidity. Unlike mutual funds, which you can usually cash out quickly, hedge funds often require you to keep your money invested for a certain time. This is known as lock-up period, which can last months or even years. Fee structures. Hedge funds usually operate on a 2 and 20 inches fee structure. This means they charge a 2% management fee on assets annually and take 20% of any profits. This is much higher than fees for traditional mutual funds. Types of hedge funds. Hedge funds come in various forms, each with its own strategy. Long, short equity. These hedge funds look to profit from increases or decreases in stock prices. By going long, they buy stocks expecting them to rise. Going short, they sell stocks they think will fall. Market neutral. This strategy aims to reduce market risk by balancing long and short positions. The goal is to focus on specific stock movements rather than overall market trends. Event-driven. These funds focus on corporate events such as mergers, bankruptcies, or reorganizations. By predicting how these events will impact stock prices, they try to make a profit. Global macro. This type of hedge fund makes huge bets based on global economic events. They might invest in currencies, commodities, or bonds, seeking to capitalize on macroeconomic trends. Hedge funds are complex and require a solid understanding of financial markets. For those with the means to invest, they offer diverse opportunities to potentially boost wealth, but always with the caveat of higher risk. The structure of hedge funds. Hedge funds are like high-stakes poker games for investors, but with more rules and fine-tuning. They are structured in a way that maximizes returns while managing risks. Let's dive into the roles of key players and the requirements for investors who want to join this exclusive club. Fund management. Imagine a ship navigating through stormy seas. The fund managers are the captains steering the hedge fund towards profitability. They hold the ultimate responsibility for making investment decisions and charting the course. Here's what they do. Strategic planning. They decide which assets to buy or sell based on thorough analysis. Risk management. They assess potential risks and implement strategies to minimize them. Performance monitoring. They continually track the fund's performance and adjust tactics as necessary. Assisting the managers are analysts, the navigators who help read the financial maps. Analysts provide crucial data and insights, ensuring that every decision is backed by deep research and fresh information. Investor requirements. Not everyone can jump on board a hedge fund. These investment vehicles cater to accredited investors, a term with specific legal implications. So, who qualifies? Income benchmarks. Investors usually need a high income, often above $200,000 annually for individuals, or $300,000 for couples. Net worth criteria. A net worth exceeding $1 million, excluding the value of one's primary residence, is another standard requirement. Institutional players. Entities like banks, insurance companies, or large corporations often qualify due to their substantial assets. Why are these barriers in place? They help ensure that only those with sufficient financial knowledge and wealth undertake the inherent risks of hedge investing. These safeguards also keep the fund within regulatory guidelines, minimizing oversight issues that could arise otherwise. Understanding the structure of hedge funds is like knowing who does what in a movie production. From directors, managers, creating the vision to producers, investors, backing the project, each plays a crucial role in crafting a successful blockbuster. Investment strategies employed by hedge funds. Hedge funds are like the Swiss Army knife of the investment world. They employ a variety of strategies to try and generate high returns, unlike traditional funds which usually stick to one kind of investment. Let's take a closer look at two popular strategies used by hedge funds: long-short equity strategy and arbitrage strategies. Long-short equity strategy. Imagine you're betting on horses at a racetrack. Instead of just picking one to win, you place a bet on one to win and another to lose. Long-short equity strategy works in a similar way. Hedge funds invest in stocks they believe will increase in value, long, and bet against stocks they expect to decrease, short. How it works. Research. Funds investigate stocks thoroughly to identify potential winners and losers. Invest long. Buy stocks expected to rise in value. Sell short. Borrow stocks expected to drop and sell them. If the price goes down, they buy them back at a lower price and return them, pocketing the difference. Risks involved. Market movements. If the overall market rises, even poorly performing stocks might increase, which impacts short positions. Stock selection. Choosing the wrong stocks can lead to losses. Regulations. Government rules on short selling can change, affecting strategies. While this strategy can balance risks and returns, it's not without its challenges. Success relies heavily on picking the right stocks both to buy and to short. Arbitrage strategies. Arbitrage is like a game of spotting differences. It's all about taking advantage of price inefficiencies in different markets or forms. Arbitrage strategies can be a bit complex, but they are crucial for managing risks and ensuring profits. Types of arbitrage. Merger arbitrage. This involves betting on the stock prices of companies involved in a merger or acquisition. Buy the target company's stock expecting it to rise, and possibly short the acquiring company's stock. Convertible arbitrage. Here, funds trade convertible securities, like bonds that can be turned into stock. They may buy the bond and short the underlying stock, profiting from interest or dividends. Statistical arbitrage. This relies on mathematical models to find price differences among related stocks, buying the undervalued and shorting the overvalued ones. Arbitrage strategies often require quick decisions and a keen eye for detail. They involve risk management, efficiently handling the risk of price changes, currency fluctuations, or interest rate differences. Market timing. Success depends on quickly capitalizing on temporary market inefficiencies before others do. These strategies can be thought of as a cat-and-mouse game, where hedge funds must be fast and smart to take advantage of fleeting opportunities. Whether it's betting on stock movements or hunting for price gaps, hedge funds employ diverse strategies to navigate the investment landscape. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.